In this week's video, we'll look at the stock market's trend from 30,000 feet to see what we can learn about 2024. We'll be moving quickly, so feel free to use the pause button on your video player. Before we get into the more important and longer-term topics, if you're concerned about the start to the year from Bespoke, this is just the fifth time that the S&P 500 has started the year with back-to-back declines of 0.5% or more. Two of those years, 1980 and 1991. The rest of the year, the return in the S&P 500, case A, 29%, case B, almost 30%. Via Urban Carmel, data from Mark Hulbert. First trading day of January, first 2 trading days of January, first 5 trading days of January, the entire month of January. In terms of the historical data, it's not particularly meaningful relative to trying to forecast the rest of the year. Said numerous times in 2023 that we needed to see market breadth improve, research from Sentiment Trader. Given this subheading, buying is so broad and persistent that it's historic. It's probably fair to say that breadth did improve. In a manner that's only been seen 16 previous times, 100% of the cases, the market was higher a year later. Average gain 18.7%, median gain 17.7%. And maybe more importantly, again from Sentiment Trader, no signal suffered more than a 6.8% drawdown at any point within the following year, yet every single enjoyed a double-digit gain at some point. There's nothing here, here, or here that's going to contradict anything that we cover in the rest of this week's video. In this segment, we'll talk about what we need to know about secular trends and how we can use that information to make better decisions walking forward. We know the stock market historically has had a tendency to alternate between periods of secular stagnation and secular or long-term bullish trends. This is the chart that we used in the June 16, 2023 video. Let's move into calendar year 2024 and see where things stand. Chart on your screen is dated January 4th, 2024. We'll do the calculations for this exercise as of Friday, January 5th. The lowest low in the periods of secular stagnation denoted by the orange boxes occurred in 1942, 1974, and 2009. And since we know the number of calendar days between this major low in 2009 and January 5th of 2024, we can try to get some idea of where we may be relative to the historical cases, more specifically the 1950 to 1968 bull and the 1982 to 2000 bull. A similar point to January 5th of 2024, February 23rd, 1957. Similar point to the present day in this bull, July 31st, 1989. In the 1957 case, while the market had moved a long way relative to the rearview mirror, there was still significant upside ahead for patient investors. Final peak in the secular bull did not occur until November 29th, 1968. The gain between point A and point B, an additional 149% in the S&P 500 index. Keeping in mind July 31st, 1989 is similar to January 5th, 2024. In this case, the A to B upside, an additional gain of 341% in the S&P 500. And if we walked forward from February 23rd, 1957 until the final peak that was reached on January 11th, 1973, the additional gain between point A and point B, even more attractive, 177%. But for the purposes of this exercise and the purposes of our model building, we're going to treat November 29th, 1968 as the end of the secular bull. And this is the beginning of the period of secular stagnation. Remember, in the past, we've noted that at the end of the trend, there's somewhat of a gray window in there where that handoff takes place from this secular trend into the period of secular stagnation. The same is true when you're leaving the period of secular stagnation and returning to a secular bull. One of the reasons why it's helpful to have objective methods to try to differentiate between a secular trend window and a window featuring a period of secular stagnation is that the drawdowns tend to be larger and sometimes significantly larger during the periods of secular stagnation. Human nature being what it is, when we see a figure like this or a figure like this and we hear that the market may be in a secular trend, we may think that things are going to be very, very easy walking forward, and for the most part, the stock market's going to go up. Well, as we've noted in the past, that's really not the way it works. Secular does not mean easy, and let's put some context around that. In this secular trend window here, denoted by the blue box, when you're trying to capture that 149% gain, there are 9 significant drawdowns that we studied. Average drawdown 14.24%, the median drawdown just a little over 10%. Similar situation in this window. It may seem easy that the market moved from point A to point B and gained an additional 341%. But inside of the blue box, we studied 11 significant drawdowns greater than 6%, the average drawdown 10.68%, the median a hair under 10%. 11 cases in this window, 9 cases in this window. If we look at all 20 cases, average drawdown 12.28%, median drawdown 9.94%. 75% of those 20 cases, the drawdown was less than 14%, and 85% of those 20 cases, the drawdown was less than 20%. Thus, in 2024, regardless of what happens in the next 3 days, the next 3 months, or even the next 12 months, if it still looks like a secular trend, our goal is to navigate between a point A and a point B that could be several years down the road. And looking at all of this with the benefit of hindsight, all of it seems relatively easy. But in the real world, we all know that's not the case. We're all human, and thus, fear of the drawdowns that for the most part we know are coming, that fear is the enemy of capturing these returns between point A and point B. Thus, when we're building models, it still looks like we're in a secular trend. The way that we deal with a drawdown within the context of a secular trend is going to be different relative to the way that we deal with a drawdown when it no longer looks like a secular trend. So in these instances, let's call this mitigation level 1. What does that mean? We're trying to mitigate these drawdowns, knowing that our primary goal is to capture this and or this, and in reality, to capture a reasonable and significant portion of this while managing risk between point A and point B. Now, if we knew in advance, somebody said, to capture this return and or to capture this return, all you really need to do is tolerate drawdowns between point A and point B. Again, when the market's closed, when you're watching a video over the weekend or on a Monday or Tuesday, it's really easy to say, I can do that. It's different when there's red all over your screen. We also know when we leave those secular trend windows, the drawdowns can be extremely damaging and extremely painful. And the way that we handle those will be different. We'll call that mitigation level 2. And all of this relates to portfolio management strategies and tactics, and more specifically for us, model building. If we're collecting all of this data, how are we going to use it? The older you are, the closer you are to retirement, and the larger your net worth, most likely mitigation level 2 is going to be important to you, and here's why. From a psychological perspective and a sleep at night perspective, it's not going to be a lot of fun if our $1 million turns into hypothetically $500,000 or $464,000, and maybe more importantly, if that drawdown occurs over 944 or 770 calendar days, which was the case in these historical cases. This is the average duration. This is the median duration. And 944 calendar days says your portfolio is falling for 2.6 years. And if you're in retirement, that's not going to be a lot of fun. You probably don't want that to happen. And you're never going to be able to sidestep market declines. Your goal is to mitigate these losses, to lose less, hopefully significantly less. So we have to understand, how do I use this knowledge and this knowledge and this knowledge and this knowledge to increase the probability of successfully navigating between point A and a point B that may be several years down the road in the context of a secular trend, using loss mitigation level 1. And our models and our strategies and tactics should be designed to help us avoid common mistakes made by human beings over and over again. How do we make sure that we don't focus on this too much and fail to participate in this A to B move or fail to participate in this A to B move in a meaningful way? So where do we stand relative to the data during the first week of January 2024? Does it still look like a secular trend? Or should we start getting concerned about a very large drawdown that has a tendency to occur outside of the context of a secular trend or in a period of secular stagnation? The good news is, as of the close on Thursday, January 4th, based on the data that we have in front of us today, we remain firmly in secular trend territory. And we've got much improved trend strength model numbers relative to where they were at the end of October. Not making any assumptions about what any of these numbers will look like in the coming days or weeks, but that's what we have in front of us on January 4th, 2024. And if we experienced a similar A to B move relative to this window here, and a similar A to B move relative to this window here, hypothetically, based on projections that would be similar to November 29th, 1968, and March 24th of 2000, the current secular trend hypothetically could end between August of 2034 and October 2035. Very, very similar to the projections that were made using demographic data. We know that peak earning and spending years typically occur between the ages of 35 and 54, with 45 to 54 being the peak window. And in that window, you have a tendency to produce more than you consume, and thus you have excess earnings to spend, save, and invest. If we look at the four major generations, Boomers, Gen X, Gen Y, and Gen Z. In 2024, the oldest Boomers are 78, the youngest Boomers are 60. Gen X, 59 to 44, Millennials, 43 to 28, Gen Z, 27, youngest 12. If we take the average and the median of these 8 ages, 2024, it comes out to be roughly 43 or 44. And if we do the same thing walking forward between 2024 and 2035, the median age of these major demographic groups will range between 44, 54, or 55. And in 2025, next year, if you take 44.88 or 44.5 and round it up, that median gets into the prime window of 45 to 54. So between 2025 and 2035, these generations that make up approximately 84% of the U.S. population, their median age will range between 45 and 54. That should be very good for economic growth. With a historic surge in market breadth, a still healthy-looking secular trend, and an extremely favorable demographic window coming between 2025 and 2035, it's fair to say that it still looks like a secular trend, and thus our goal is to navigate between a point A and a point B that could be several years down the road. We want to make sure that we handle drawdowns in a reasonable and prudent manner within the context of our primary long-term goal. And we all know the only way that we can do that effectively is if we head into next week and every week with that flexible, unbiased, and open mind. The material in this video has no regard to the specific investment objectives, financial situation, or particular needs of any viewer. This video is presented solely for informational purposes and is not to be construed as a solicitation or an offer to buy or sell any securities or any related financial instruments, nor should any of its content be taken as investment advice. Any opinions expressed in this video are subject to change without notice, and Shivako Capital Management, LLC, or CCM, is not under any obligation to update or keep current the information contained herein. CCM and its respective officers and associates or clients may have an interest in the securities or derivatives of any entities referred to in this material. CCM accepts no liability whatsoever for any loss or damage of any kind arising out of the use of all or any part of this material. We recommend that you consult with a licensed and qualified professional before making any investment decision.